So let's get straight into it. The big topic at the moment, or one of the big topics at the moment coming out of the US, are the recent inflation numbers that have come out. So we had a reading a couple of days ago where inflation's now come in 3 months in a row in the US at slightly higher than expected. And perhaps more importantly, inflation for the last 3 months, albeit the numbers aren't huge, inflation's gone up rather than down. So let's talk about it. We'd be eager to hear from you in terms of what this means for interest rates.
Yeah, sure, Eugene, you're absolutely spot on. We've seen a re-acceleration in inflation in the United States. We've just seen the March CPI number, and what we saw was, albeit rather marginal, but we saw a slight worse than anticipated month-on-month reading. The problem is that this is the third successive month-on-month increase that has been higher than anticipated. And what that therefore means is that the 3-month annualized rate for US consumer price inflation is now running at 4.6%. I'll just repeat that. The annualized rate of change for US CPI over the last 3 months is now running at 4.6%. You will remember that at the end of 2023, US CPI was running at a 3-month annualized rate less than 2%. So the numbers are suggesting that we are witnessing a re-acceleration in the rate of inflation. And the problem with the data is if you dig beneath the headline, it gets even worse. And what we're seeing is further confirmation of a stickiness in service-based inflation. Eugene, you and I have fond memories of me prattling on 3 years ago now about owner's equivalent rent, which is a measure of US rental inflation, and how significant the rise in that was. Well, here we are 3 years later, and one of the greatest contributors to the rise in US inflation is, of course, owner's equivalent rent or shelter. And now you might also remember, Eugene, at the end of last year, Jerome Powell and many economists in our industry were trying to get us to focus on what they called super core services inflation. I'll repeat that, super core services inflation. And this is one of these wonderful little statistical tricks that our friends in the economics and central banking community play with us every now and then. But basically, they strip out everything that is necessary to live and then tell us that inflation is disappearing. Now, super core services inflation excludes food, which I think is fairly necessary, energy, and shelter, i.e. housing costs. Because, of course, they were tired of food prices rising, energy prices rising, and, of course, shelter. So they decided to create a new measure. And Jerome Powell referenced this several times last year because, of course, super core services inflation was actually seeing quite a deceleration in the rate of inflation. However, as these things usually do, they've come back to bite him you know where, and super core services inflation is now running at a 4.8% year-on-year rate. And in fact, if you annualize the last 3 months, it's in excess of 8%. So guess what? Jerome Powell won't mention this in his next press conference. And suddenly economists who were telling us that we were racing to 2% year-on-year inflation in America won't mention it either. The bottom line is we're witnessing a re-acceleration in the rate of inflation. And we all know, of course, that crude oil prices have been rising sharply, gasoline prices in the United States. We've seen recent sharp increases in copper prices. And so I'm afraid we're looking at an inflationary environment, which I think, Eugene, you and I spoke about this in 2023. the kind of easy bit for US inflation was to get it from an annual rate of 9.1%, which was the peak, if you recall, and it's going to fall pretty quickly to 4%. And then the journey was going to get much more challenging, getting to 3 and then sub 3. So I'm afraid we are witnessing a recalibration of inflationary expectations by the markets just in the last few months.
Yeah, it seems that way. And yeah, we did talk about that last year, and possibly markets have underestimated, the fact that it is probably going to be difficult or more difficult to get from around 4% to the sort of sub 3%. So if we agree that now inflation is starting to tick up again, as opposed to coming down, which is what was forecast by most, and is certainly what was driving some of the aggressive rate cut forecasts that were being put out there, even as recently as 3 or 4 months ago. We've gone from perhaps 6 or 7 rate cuts being expected 4 months ago to what, 2 at the most this year? I mean, how could you? They're not going to cut in June, surely, after this. So we're looking at it. But can they really cut rates if inflation's going up instead of down and is still above 3%? So what do you think is more realistic now in terms of what rates are going to do in the US?
Well, it's a great way you've summarized it. I agree with you, Eugene. I don't see the Fed being able to cut rates in June. And don't forget, as you just said, in January, the market was pricing 6 rate cuts in 2024. And in fact, in January, the first cut was going to take place in May. That's off the board. And then the market said, okay, the first one's going to be June. Well, that's now, I think, taken away, and I agree with you. But then we get into really tricky territory, don't we? Because, of course, we've got this thing called the US election in November. And so the calendar or the window of opportunity for the Fed to be cutting is narrowing now, because if we've ruled out May and now ruled out June, goodness me, there aren't that many meetings between July and November. So now the market appears to be saying the latest pricing is roughly around 2 rate cuts in 2024. However, a number of commentators or economists have recently said that, as following last week's CPI number, the Fed is unlikely to cut at all in 2024. And so the Fed now faces a bit of a conundrum. And I'm afraid this is, again, why the markets took a bit of a hit following that CPI release. And don't forget also, which I know we'll talk about later, Eugene, we've got to also thread into our conversation the reality of what's happening on the geopolitical front, because that does also have inflationary ramifications. But ultimately, I think you're right. I think we can now rule out a June rate cut at the Fed, and we're kind of trying to concertina in a couple of rate cuts, but the market is now effectively pricing only 2 rate cuts for the remainder of this year.
Yeah, and which is probably optimistic, I would say, unless the data changes dramatically, say between now and June. My view is that would be pretty optimistic. And it's interesting how, markets were pricing in these aggressive rate cuts. It's now not gone from 6 to 2 rate cuts, yet equity markets have been pretty resilient, right? Like, we're a couple of percent off the all-time highs of the major US indexes and Australian index for that matter. So interesting to see how that plays out.